Everyone's focused on the Magnificent Seven, but there's something bigger happening beneath the surface. And with earnings hitting this week, the window to get positioned is closing fast. It's not just about the numbers, it's about a shift that's already quietly underway. Most won't see it until it's too late. Let's take a closer look. Starting off, let's just have a look here on the S&P 500, which is up 10 points right now at 55.64. And we have a market that more or less has made it back to its 50-day moving average and back to its Fibonacci retracement zones. This here is actually a very key level in my mind. And it's no coincidence that the market is hovering here into the news, as the news will almost certainly become the catalyst as to whether or not we get a strong bullish breakout above that, or whether this is the failure point. Now, to me, this is an incredibly asymmetric spot from which to engage this market, because here a failure at this point leaves a substantial downside opportunity if this whole market rolls over. At the same time, any short-term rallies here, even if, let's say, we have a bunch of the Mag 7s actually do well, like the way sort of Google gapped higher last week, and at the same time, let's say the jobs numbers is that this wasn't the month when things broke. And if we see this kind of a circumstance coming in, then maybe we see 5,700. Like we could have a quick pop up towards 57, 5,800 and retest that March high that came in right over here. This is entirely a reasonable target zone up above. And we'll be watching whether or not that becomes that key overhead resistance point, even if we did have that short-term rally. Overall, I stand firm on the idea that this is a bear market rally, and that inevitably the stock market will have another leg lower. What we're just trying to determine is where is that kind of fulcrum point of pivoting the market. I want to highlight that, for instance, in the 2008 financial crisis, after the first leg lower in January of 2008, the market stayed in a bear market rally mode for over 3 months, as it didn't start rolling over until May of 2008. Point being that just because we're overall bearish and think that we are in a period where there's going to be further distribution, it doesn't mean it's all going to happen right away. And this is why this news is pivotal, because I feel that if the market can get past these earnings and get past the jobs numbers without it being a trigger point for a downside breakdown, then the market is likely to go into May into a bit of a holding pattern where it has limited upside but no immediate reason to start going down, and that will make it a far messier, choppier environment. Now, what's the likelihood that this market just has its feet kicked out from underneath it and the next leg lower is going to get underway? Well, I mean, I don't know if I want to put a strong probability on it. What is going to be far more important is observing when we're seeing technical breakdowns that are indicating that the downside window is open. What level do I need all of you to watch? Well, right here, I'm just going to do a Fibonacci of this a recent rise. And let's just say that this 5,300 level, which is the bottom of this fib zone right over here, is a very good line in the sand, as we could, for instance, have a quick negative reaction, drop 150 points, and the market could immediately be bought on dip and rise on that. It wouldn't actually open the downside floodgate on there, where I feel that the feedback, negative feedback loop, and spikes in volatility and all of the things that would be associated with sell-off are all going to happen under that 5,300 level. And so this is now going to be a very key pivot level for all of you to watch. So let's just highlight a couple of things on these equity markets. First of all, let's just touch on the Mag 7 chart. So this is the ETF that just holds the Mag 7s. And you can see it was a relative weakness is there compared to the rest of the market. But that in itself actually leaves the window open for there to be a short-term bullish impulse, because there's so much negativity being built into the Mag 7s that cause that selling, that if things are not worse than everyone was already expecting, then a relief rally can happen, just the way we saw in Google. And so this, to me, is actually something that is on the table. Could we see this rally to $50 right up along here, and we see close to a 5 to 7% little impulse higher? It's on the table. Notice that we have this 50-day moving average sitting right there. I think it's a very simple arbiter for all of you to use, which is, look, if the Mag 7s can clear the 50-day moving average, especially on all of the positive earnings, then you want to give the bulls a little bit of benefit of doubt that for another week or two, there could be some further gains. But a failure at this 50-day and a remaining below the 50-day means leave it alone. It's not done. And at that stage, you want to just let the cycle finish playing out before considering any new opportunities there. From a volatility perspective, we had a proper collapse in vol, which has been a tailwind for the markets, because it's called a Vanna effect, which is as volatility contracts, dealer hedging is not as necessary, which causes them to buy back a lot of their hedges and offer a natural buying tailwind to these markets. And so we have a scenario now where the market volatility has come back down to what I think is a very reasonable level for it to stay at. Do I think we could go all the way down to 20? Well, maybe if we had a bullish reaction, could we see volatility get down to the 20 handle? But I would be much more likely thinking that we're going to see this thing sit around this 23 to 26 range until the market is ready for another round of selling, which I do think inevitably is something we're coming